Imagine a tiny boat on a vast ocean. The boat is dwarfed by the endless expanse of water, bobbing up and down with the waves. It seems almost insignificant in the grand scheme of things, doesn't it? Yet it bravely navigates the unpredictable waters, facing whatever comes its way. Now, picture a giant wave approaching. The wave towers over the tiny boat, threatening to engulf it completely. The boat's fate hangs in the balance, dependent on its ability to ride out the storm. This scenario is a perfect metaphor for certain stocks in the financial market. That's a low-float stock in a nutshell. Just like the tiny boat, a low-float stock can be easily influenced by external forces, such as institutional investors or individuals with majority ownership. The stock's price can fluctuate wildly, much like the boat being tossed around by the waves, due to the majority amount of its shares tied up in portfolios, leaving just a few left in public market to be bought or sold. Float refers to the number of shares available for trading. It's the portion of a company's shares that are in the hands of public investors, ready to be bought and sold on the open market. Key points about a company's float: what it represents, the number of shares that can be freely traded on the stock market, what it excludes, shares held by company executives, large institutional investors, or any other restricted shares that cannot be readily traded. Importance for investors: a larger float indicates greater liquidity, meaning it's easier to buy and sell shares in the market. The smaller the float, the more susceptible the stock is to volatility. A low float means fewer shares are in the hands of regular investors like you and me. This limited availability can lead to dramatic price movements when there's a surge in buying or selling activity. It's like a small boat with limited capacity trying to accommodate a sudden influx of passengers. Benefits of flotation. Instead of using retained earnings, a company can raise more capital from external sources by issuing new shares to fund capital projects, mergers, acquisitions, and other costs. Different investors may consider this addition in shares as dilutive to the total pool of investable shares. However, variety of assessments of a company's future decisions can alter their view. A company could buy back its own stock and lessen the float on the market, and prevent dilution. Companies could also purchase other assets as well, including Bitcoin, as MicroStrategy is currently doing with its strategic Bitcoin reserve. As new fiat shares are added, the company uses the selling of these new shares to purchase Bitcoin, also reducing float over time and increasing the company's permanent capital. These company actions, as well as earnings, therefore allow investors and institutions to assign personal values to stocks they hold and use these projections to aid in their decision-making to buy, sell, or hold. When one investor is willing to buy shares at a price at which another is willing to sell, then both see an opportunity from a trade. By contrast, if everyone agrees that an appropriate stock price is significantly above the previous trade price, then the shares will rise in value quickly, with more buyers rushing to the trade. When a stock has a lot of investor interest, the greater number of different views on the stock's value creates more opportunities to trade. That typically shows up in the form of narrower spreads between the price buyers are willing to pay and the price sellers are willing to accept for shares. A small number of big players, like hedge funds, often hold a significant chunk. These institutional investors can have a substantial impact on the stock's price movements. When they decide to buy or sell, the limited float can amplify the effect of their actions. When demand for these shares surges, even a small increase in buying pressure can send the price skyrocketing. It's like a wave building up and lifting the tiny boat high into the air. The stock's price can soar to new heights in a short period. Why? Simple supply and demand. With a limited number of shares available, any increase in demand can lead to a significant price increase. It's basic economics at play, where scarcity drives up value. Limited supply plus increased demand equals price explosion. This is the allure of low float stocks for many traders. The potential for quick, substantial gains is enticing, but it comes with its own set of risks. This volatility attracts a specific breed of trader, those seeking quick, explosive profits. Day traders and short-term investors often flock to low float stocks, hoping to capitalize on the rapid price movements. They thrive on the excitement and the potential for big wins. But remember, what goes up fast can crash down even faster. The same forces that drive the price up can also send it plummeting. It's like the tiny boat being caught in a sudden storm, struggling to stay afloat. The risks are high, and the ride can be turbulent. Now, let's talk about redemption plays. These are fascinating strategies that have gained a lot of attention in the trading world, especially among those who love the thrill of high-risk, high-reward scenarios. Redemption plays are strategies employed by traders, often in conjunction with low-float stocks, to put pressure on short sellers. These tactics are not for the faint-hearted and require a deep understanding of market dynamics and a keen eye for spotting opportunities. Short selling is essentially betting against a stock, hoping it will go down. Short sellers borrow shares and sell them, planning to buy them back at a lower price to return to the lender, pocketing the difference as profit. However, this strategy comes with significant risks. Here's how it works. Traders identify a heavily shorted low-float stock. Low-float stocks have a limited number of shares available for trading, which means their prices can be more volatile and easier to manipulate. They start buying shares, driving up the price. As more traders join in, the demand for the stock increases, causing the price to rise even further. This initial buying spree is crucial as it sets the stage for what comes next. As the price rises, short sellers feel the pressure. They see their positions turning into losses and face the dreaded margin calls from their brokers, which can force them to take action. They might be forced to buy back shares to cover their positions, further pushing the price higher. This is known as a short squeeze, and it can create a rapid and dramatic increase in the stock's price. This creates a feedback loop that can lead to massive short squeezes. As the price continues to climb, more short sellers are forced to cover their positions, adding more fuel to the fire. Redemption plays are like a game of poker between traders and short sellers. The traders are betting that they can squeeze the shorts out of their positions, forcing them to buy high and crystallizing their losses. The traders are betting they can squeeze the shorts out of their positions, forcing them to buy high and crystallizing their losses. This tactic requires precise timing and nerves of steel, as the tables can turn quickly. It's a high-stakes game with the potential for big wins and devastating losses. Traders who engage in redemption plays must be prepared for the volatility and the emotional roller coaster that comes with it. The rewards can be substantial, but the risks are equally significant. In the end, it's a battle of wits, strategy, and sometimes sheer luck. Now let's add another layer of complexity: options. Options are contracts that give you the right, but not the obligation, to buy or sell a stock at a specific price, the strike price, by a specific date. Gamma is one of the options indicators, which are measures of risk and potential reward associated with options. Gamma measures the rate of change of an option's delta. Delta, another indicator, tells us how much an option's price will move for every dollar change in the underlying stock price. Think of gamma as the acceleration of an option's price movement. A high gamma means that for every dollar the underlying stock moves, the option's delta will change significantly. This can make options extremely sensitive to price swings, especially near the expiration date. Now, let's combine options with low-float stocks. This combination can create a powerful and volatile market phenomenon known as a gamma squeeze. But what exactly is a gamma squeeze, and how does it unfold? Let's break it down step by step. When a low-float stock starts to move rapidly upwards and there's significant open interest, meaning the number of outstanding options contracts, at a particular strike price, things get really interesting. The low float means there are fewer shares available for trading, which can amplify price movements. The open interest indicates that many traders are betting on the stock's future price movements, often through call options. Here's how the gamma squeeze unfolds. It all starts with a spark, a catalyst that ignites the initial price movement. This could be positive news about the company, a strong earnings report, or even a social media frenzy. Once the stock starts to rise, traders begin to take notice. First, we have the spark. Traders buy call options, which are options to buy the stock, on the low float stock, anticipating a price surge. These call options give traders the right, but not the obligation, to purchase the stock at a predetermined price, known as the strike price, before the option expires. As more traders buy call options, the demand for these options increases. This is where delta hedging comes into play. Market makers who sell the options need to hedge their risk. They do this by buying shares of the underlying stock. The more call options they sell, the more shares they need to buy to hedge their positions. Market makers who sell the options need to hedge their risk. This process is known as delta hedging. Delta measures the sensitivity of an option's price to changes in the price of the underlying stock. To hedge their exposure, market makers buy shares of the stock, which in turn pushes the stock price higher. They do this by buying shares of the underlying stock, further pushing the price up. Then, gamma ramps up. As the stock price rises and gets closer to the strike price of the options, gamma increases. Gamma measures the rate of change of delta. As gamma increases, the delta of the options also increases, meaning market makers need to buy even more shares to stay hedged. As the stock price rises and gets closer to the strike price of the options, gamma increases. This means that market makers need to buy even more shares to hedge their positions, accelerating the price rally. The higher the gamma, the more shares they need to buy, creating a feedback loop that drives the stock price even higher. This means that market makers need to buy even more shares to hedge their positions, accelerating the price rally. The increased buying pressure from market makers can attract more traders to the stock, further fueling the upward momentum. This is where the gamma squeeze starts to gain serious traction. Finally, we have short squeeze fuel. The rising stock price puts pressure on short sellers, who may be forced to cover their positions, further fueling the upward momentum. Short sellers borrow shares to sell them, hoping to buy them back at a lower price. But when the stock price rises, they face potential losses and may need to buy back the shares to cover their positions. The rising stock price puts pressure on short sellers, who may be forced to cover their positions, further fueling the upward momentum. The result? A perfect storm of buying pressure that can send the stock price parabolic. This combination of gamma squeeze and short squeeze can create explosive price movements, leading to significant gains for those who are long on the stock. A perfect storm of buying pressure that can send the stock price parabolic. Understanding the mechanics of a gamma squeeze can help traders navigate these volatile market conditions and potentially capitalize on the opportunities they present. So the next time you see a low float stock with high open interest in call options, you might just be witnessing the beginning of a gamma squeeze. Combining low float dynamics with a gamma squeeze is like mixing high-proof alcohol with an energy drink. You get a potent cocktail of volatility and risk. It's a recipe for potential massive gains, but also catastrophic losses. Traders who understand these dynamics and time their entries and exits perfectly can make a killing. However, it's a high-risk, high-reward game. The moves can be swift and unforgiving. Imagine trying to ride a rocket ship without a seatbelt. Understanding stock volume, float, and volatility. 1. Stock volume, the heartbeat of market activity. Trading volume refers to the number of shares traded in a stock over a specific period, typically a day. It measures the level of activity or liquidity in a stock. Key insight: trading volume reflects investor interest. Stocks with consistently high volumes are often more liquid and less volatile, making them attractive to institutional investors. Volatility: the nature of price movements. Volatility describes how much a stock's price fluctuates over time. It is directly influenced by float and trading volume, aligning a business strategy with market fundamentals and scalability. Much like understanding float and liquidity is crucial to navigating stock markets, we gravitate our attention to Bitcoin's fixed supply dynamics and global adoption. Trajectory and growth are essential for companies and investors looking to stay ahead in a rapidly evolving financial landscape. Companies utilizing financial engineering, establishing a Bitcoin reserve such like MicroStrategy, will over time maintain market leadership. developing permanent capital with a buy incorporating Bitcoin into their strategies, businesses can not only future-proof themselves against inflation, but also position themselves as leaders in this new paradigm shift. Generating financial feedback loops through creating a resilient financial structure is critical to perpetuating growth.